As people trickle in here over the next minute or two, I'm just going to give people a second to get settled in. Thank you so much for joining us. We'll get started here in a minute or two. Thank you. Just give me a minute for people to come into the webinar. So just bear with us for a minute or two. All right, let's go ahead and get started. My guess is we'll have more people trickling in, but don't want to make people wait who are on time. So this webinar for this month was actually requested by a client, and I think it was a great suggestion, which is for people who are starting out in the workforce or still in college. What should they be thinking about around financial planning, financial literacy, setting up accounts, investing, all that type of stuff. So we created this webinar, and we actually have an intern with 4J Wealth for the summer, Roger White from William & Mary, who did a lot of work on this presentation. So I want to thank him for his work, and he's attending today. And this is also being recorded and will be uploaded to our YouTube channel. So to the extent someone might benefit from this information, we would certainly encourage you to share our YouTube channel with them so that they can watch this. So young adults, financial literacy and planning. We realize that this is not something that is taught in school, and it's extremely important. So you go into the workforce and you start doing your job, but no one's really taught about what to do with their money after they earn it. And so a lot of times people don't make the best decisions. So the information we have presented here is things you want to think about and things you can do to put yourself in a really strong position early on in your career. Quick disclaimer here, obviously, this should not be construed as advice. This presentation is solely for information purposes. If you have questions that pertain to your particular situation, we're happy to answer them individually. If you have questions that are more general in nature, feel free to put those in the Q&A, and if we have time at the end, which we probably will, we can go through and address those questions. So feel free to type any question you want to the Q&A, and we look forward to answering them. Okay, so this chart goes back to the 1960s and looks at the personal savings rate of disposable income for Americans. And as you can see here, from 1960 to about the 1980s, people were saving about 10 to 15% of their income. And then really since the late 90s, early 2000s, people have dropped their savings rate, where they're only saving about 5 to 10% of their pay, sometimes even less. And if you look most recently, there's some funny things going on in the graph there, and that's because of the coronavirus stimulus packages. So you had a weird situation where people were getting money injected into their accounts, but they really couldn't spend it. So it's showing the savings rate is going up drastically over a short period of time. We think that will level out and normalize back to that 5 to 10%, but that's really not enough. We want to shoot for that 10 to 15, 10 to 20% savings rate. That's what you should be targeting when you start out. So this is a little bit of a surprising, disappointing graph showing that nearly half of Americans actually don't have any savings. This was a survey done in 2019. and beyond that, most have maybe 1 to 5,000. Very few have over 5,000 in savings. So for young people starting out, getting in the habit of saving a portion of every paycheck is critically important, so that you can avoid being in this type of a situation. So I think in our opinion, it all starts with understanding where your money is going. And so there's a rule of thumb in the personal finance industry called the 50-30-20 plan. And the 50-30-20 plan is where 50% of your income goes towards necessary spending. So necessary spending, that's going to be things like your housing, food, medical costs, things of that nature. 30% goes to discretionary spending. Okay, so what that means is you want to go out to the movies with some friends, go out and get a drink, do something social. That would be deemed discretionary spending. And then 20% ideally should go to some sort of savings. So if you can follow that 50-30-20 rule, it sets you up to be in a very, very good position. And that can be hard starting out because you don't really know, your money just kind of goes wherever it goes. So what you want to do is try to have some semblance of a budget. So you can track, okay, here's what's coming in and here's what's going out each month, and here are the categories it's going out to. And you can do that through something as simple as a spreadsheet. A lot of banks now have tools to track spending, credit card companies have tools to track spending, and then there's also online sites like mint.com where you can track your spending and have it done, pretty much automatically once you categorize your main expenses. So the way you should think about saving is it's investing in your future. So the first thing you want to do is pay yourself first, right? That's a good basic rule of thumb, is pay yourself first, and we'll talk about how to do that. The second thing you want to focus on is building up an emergency reserve. And we'll come back to this, but it's a pool of money covering about 3 months worth of expenses where you have it available in cash, where if something unforeseen happens, the car breaks down, you get a flat tire, you have a major medical expense, you don't have to go into debt in order to pay that bill. And the third part of a solid strategy for saving for the long term is once you have that emergency reserve built up, everything above and beyond that should be invested for the long term. And we're going to talk about this, but it's a concept known as compound interest that really starts to work in your favor. It's hard to appreciate it when you're young and starting out, but we're going to show you some graphs so you can see how much of an effect it will have later on. The biggest financial regrets, this is a bank rate survey that was done, too little emergency savings, that was 20%. So the biggest regret was not having enough just in cash to be able to pay bills. Second biggest regret was too little retirement savings. And third biggest regret was having too much credit card debt. All of those things, those top 3 things, come down to having a budget, getting the basics right, and getting good habits in place when you're young. All 3 of those can be avoided by doing those things. All right, so now let's break it down and look at them one by one. So the first thing, savings can be broken down in a few simple steps. Number 1, pay yourself first. So what does that mean? It means that the first time you get a paycheck, you can elect what you want to do with it. There's an automation process, or you can automate this process where you decide to put in 10% of your paycheck so that it goes automatically into your 401k. So what that means is that the first time or second time you get paid with your job, 10% will come out and directly go into your 401k account. This is a couple really big advantages. 1 is you're paying yourself first. 2, it happens automatically. So after a few months, you're not even going to think about it or feel it. It's just going to go in and it's going to become a habit. And then third is it does reduce what you're going to owe to the IRS and taxes in the year that you contribute this money. Any money you put into a 401k reduces your taxable income. So between those 3 things, you have a pretty powerful combination. In addition to the 10% to the 401k, we'd also like to see 5 to 10% going to savings. And what we mean by that is you can actually have your paycheck go 80%, for example, or 90% to the net amount you would get to your checking account. And you can tell the benefits department, I want this percentage or this amount going to another account, and it goes into a savings account. So what we've done essentially by contributing to the 401k and earmarking that separate account where that money gets automatically saved is you're paying yourself first. The money that you actually get into your account that you spend is going to be spendable money because you've already done your savings. So with the savings, what we want you to target is build up a savings account, just a pure cash type of account, equal to about 3 months worth of your expenses. So if you spend, $3,000 a month between your rent and everything, we want to see about $9,000 is what we would advise having in a savings account that is only touched in the event of an emergency. It's not touched for a gift. It's not touched for, a new phone or TV that you want or a game. It is earmarked for, I didn't expect this expense to happen. I have to pay it. Let me, I can't fund it through cash flow, but that's why I have this savings. Critical to do. Once you get to that 3-month goal, and that's a huge accomplishment because now you've built up that emergency reserve, now you can start to really build your long-term wealth. So step 3 is to invest for the long term. Think retirement, your first house, just basically where you're going to be in the next 15, 20 years. The money you put away today is going to take care of you in 10, 15, 20, 30 years, and in a big way. So beyond the 401k contribution, and once the emergency reserve is reached, you want to automatically invest every month without thinking about it into either a diversified mutual fund or a collection of funds, in our opinion, in order to achieve a rate of return above inflation that will help your wealth compound over time. So we define wealth as having assets that earn while you sleep. And when you invest in an S&P 500 index fund, that's a really good example of wealth, right? Because it's assets that you're invested in companies that are, working every day to grow their bottom line, to increase their customers, to increase the revenue, even if you're not doing anything. Okay, and this is the big key. So the power of compound interest. That's really when you invest for the long term, you're taking advantage of the power of compound interest. And here's a really good example that Roger put together where it looks at if you just start with an initial investment of $100 and you're consistent. So every month you save $100, okay, into an investment account. And hypothetically, let's say that over time, that investment returns 8% per year, okay? What that will mean is that over 40 years, okay, your account balance based on starting with 100 and putting in 100 per month will have grown to $300,000. That's what that red line represents. The blue-green line there shows the amount that you would have put in. So you can see as, after 10 years, there is some difference, but it's not a huge difference. Look at the spread between year 10 and year 20 though. The red line really starts to accelerate, above the green line, and then year 20 to year 30, and really year 30, 40, you can see the exponential nature of compound interest. And so that's why a lot of times as people save and save and save, they accrue the most wealth after year 30, because right between year 30 and year 40, that's where most of this money is made. So you really want to try to take that long-term approach and just have that consistency. It doesn't require a huge amount of money. It just requires starting early and being consistent. That's the most important thing to becoming wealthy over time. This next chart here highlights the importance of starting early. Okay, so what we're going to look at here is the orange bars. The orange bars you can see here represents the following. You start saving at 25 and you save 10% of your salary. So if you're making $60,000, you save 10% of the salary, and it is so that's $6,000, and it assumes a 3% match, right? So 13% total amount of money being saved. A lot of times when you contribute to a 401k, another big benefit is they will match you. So it's essentially free money they're giving you. So if you put in X percent, they'll match you 3%, could be 4%. And so that's free money you're giving away if you don't do that. And if we tack on here, we put a hypothetical 7% per year return, you can see between 25 and 55, the person who started young would have accumulated over $1 million in assets, okay? The same exact person who didn't start at 25, waited till 35, assuming an annual salary $20,000 larger, so at 35 they're making 80,000, not 60. Everything else stays the same, and they contribute between 35 and 55. They have about half as much money saved. So just those 10 years between 25 and 35, even when you're not making necessarily what you're going to max out at, you have such a big head start, and because of compound interest, the person who started younger, they can't be caught, right? Certainly not easily. And the other importance, I would say, if you have the option of choosing between a percentage that goes into your retirement account or a flat dollar amount, do the percentage. And the reason is because as you get raises, if you do a flat dollar amount, you have to remember each time to go back and change how much you're putting into the 401k. If you do a percentage, it'll automatically adjust. So you get a raise from 60,000 to 70,000, right? Now, as opposed to 6,000 going in per year, 7,000 will be going in per year, and you don't have to think about it. So this to me is one of the most important slides to show the importance of starting early, and how the blue line would have to probably contribute 20 to 30% per year in order to catch up. So let's talk a little bit about types of investment accounts. This is oftentimes a question we get from young people starting out, is they want to do a Roth, or that's the only thing they're talking about is a Roth. And the Roth is a great thing to do when you're starting out, but we want to make sure that people understand how a Roth works, how an IRA works, how a 401k works, and then how just like a regular brokerage investment account works. Because most people who start investing, I don't think appreciate the differences from a tax perspective. So a Roth IRA, the reason it's so popular and talked about is it's not that easy to get money into once you're more established and making more money, because they phase out the limit. They phase out your ability to contribute if you make more than a certain amount. The way a Roth IRA works is it is funded with after-tax dollars, meaning if you put in $1,000, you'll have already paid taxes on that money. And the trade-off is that as that account grows, all that growth is tax deferred, and as long as you reach age 59 and a half, anything that you withdraw from that Roth account will come out tax-free. And that word tax-free is why everyone wants to get money into a Roth, because when they take money out, everyone's worried their taxes will be higher than they are now, and they want to create tax-free income. So that's how the Roth IRA works. And it is a great thing to do. And if you can start when you're first starting out, if you have a choice between this and an IRA, for most people, we would probably suggest the Roth because of that unique nature and the fact that you're not going to be always likely able to contribute to it. An IRA, by contrast, is funded with pre-tax dollars. So when you put money into an IRA, okay, the money that you put in, generally speaking, you're going to get a tax deduction. So it's going to reduce your tax liability today. The growth on that money does grow tax deferred, okay? So you get a tax deferral on any growth of those funds. The way the IRA works, though, is when you ultimately withdraw the money out, and because it's a retirement account, they make you wait also to 59 and a half to start withdrawing money out. When you withdraw that money out, taxes apply to the amount that's being withdrawn that you haven't yet paid taxes on. Okay, so these essentially are they're similar in the tax deferral and the age you get them, but they're kind of opposite in terms of getting the deduction up front or getting taxed when you take it out. A 401k plan from a tax perspective is very similar to an IRA, but unlike an IRA, a 401k plan can only be funded through payroll deduction. So it is always going to be attached to or linked to the employer that you're working for. So any contributions you make to a 401k, they lower your tax liability. The growth is tax deferred. And again, when you withdraw the money out, taxes are applied, okay? So the structure from a tax perspective of an IRA and a 401k are very similar. And in fact, most people when they retire, not required, but many, what they do is they do a rollover from their 401k plan into their IRA. There's no tax consequences to do that rollover. And you don't have to wait till retirement. If you're working at a particular company, you leave that company and you decide that you want to invest the money in your IRA because you have more flexibility, you can roll that 401k over into your IRA, and it is not a taxable event. Okay, you just want to make sure you follow the rules to do the rollover appropriately. And then another type of account for investing purposes is just a standard brokerage account. This is not a retirement account, so it doesn't have any preferential tax treatment. It is the most flexible option of all of these mentioned, because you could put money in one month, you could take it out the next month, and you're not going to be hit with any sort of a penalty or things of that nature. The trade-off is you don't get any special tax benefits. Okay, so it's not like if I invest in ABC fund and in 5 years I sell it and buy XYZ fund, that, you know, if it's in these types of accounts, you wouldn't pay any taxes on that gain as long as it stayed in those accounts. Whereas in the standard brokerage account, if you made that sale, you would, since it was more than a year, you'd be taxed on just the gain, right? What you made as long-term capital gains, which is lower than your ordinary income tax rates, but you'd still pay taxes on it. So a lot of people are surprised by that. There's no limit on how much you can put in or how much you can take out. So again, very, very flexible. But the last point I want to make here is that the investments you choose amongst these 4 types of accounts, don't think of a Roth account as a type of investment. You could have a Roth account and hold have it all in a money market or a savings account, earning basically 0. Or you could have a Roth IRA that's all invested in one particular stock. Or you could have it in a diversified index fund or mutual fund, right? So the type of account has nothing to do with the type of investments that you're using in that account. It's just how the account is registered and titled so that the IRS knows how should this be taxed when money is taken out or things are sold inside. Extremely important to understand that. Okay, so we're going to switch gears a little bit here and talk about credit, all right, and your credit score specifically. Your credit is something that is used by lenders, or when you want to borrow money, to determine what interest, whether they're going to lend you the money, one, and what interest rate you're going to get. So you want to know what goes into your credit score in order to figure out how to, you know, raise that over time. So whether it's a credit card debt or a mortgage or an auto loan or any other type of debt that you're going to take out, your credit is a major factor in what rate you're going to get. So maintaining a good credit score is important to minimize larger interest payments, right? And this is based on the FICO score, 300 to 850 being, you know, perfect. So we're going to talk about the main contributors of what goes into the FICO credit score criteria. And the biggest contributor is your payment history, paying on time, right? So if you are if you miss payments or more than 30 days late, and if it's a one-off thing and you have a pretty long track record, it's not going to hit you too much. But if you're consistently missing bills, that is definitely going to affect your credit. In fact, that's going to be the biggest driver of your credit score. So to the extent you can automate things via bill pay, if you go to your bank, you can look at bill pay. You can automate paying a bill, every single month, automate paying your credit cards, doing those types of things. It doesn't mean you shouldn't also have a budget. You should, but by automating those things, you make sure that you're not going to miss a payment that you otherwise would have made because you forgot. Okay, another big chunk of what goes into your credit score is the total amount of debt owed. So they look at a couple things here. One is, do you have an auto loan, a student loan, credit card debt? Do you have all of those things, or do you just have, an auto loan or student loan? How much do you owe on all the accounts in aggregate? And the third thing that's a big piece of this is what's called the credit utilization ratio. So if I have a credit card with a monthly limit of $10,000, let's say every month I charge $6,000 or $7,000 onto that, right? More than 50% of the credit allowed, that I'm allowed to pull, I actually use to buy things. And even if I pay it off every month, so I'm never late, it still adversely affects my credit because, and this is a little bit frustrating, but the way the credit agencies and lenders look at this is they say, well, if you have $10,000 of credit available to you and you're using all of that, maybe you're stretched. So you want to actually try to keep your credit utilization ratio to 35% or less. So if you have a credit card that has a limit of 10,000, you want to try to keep your monthly spend on that credit card to 3,500 or less. And you can look across all accounts. If you have multiple credit cards, you can see kind of what your total your total credit limit is, and you want to keep that credit utilization ratio across those different credit accounts to about 30 to 35% or less. Last thing here is the next big contributor is the length of your credit history. 15% of the score goes to the length of your credit history. So if you're in college or you have kids, let's say you're a parent attending this webinar and you have kids in college, you want to have a conversation with the kids about spending and budgeting and what's allowed. Having an open dialogue about finances is very, very important in our opinion to having successful kids starting out be successful with their finances. But to the extent you can get a credit card in your kid's name starting at 18 or 19, even if you're paying the bill each month, what that does is that gives your child an extra 4 years to build the length of their credit history. So it's generally, as long as they're not going out and abusing the credit card, then it kind of backfires. But if they're not, and you're just helping them build their credit, then it's a big positive. So, one of the biggest payments you're going to make for the majority of your life is your mortgage. And right now, mortgages are at a 30-year low. So it's an attractive time to lock in, a very low mortgage because you have such a low interest rate. And your credit score goes directly into what the cost of your mortgage is going to be. It's the biggest contributor. So as you can see here, it gives you kind of a range of mortgage interest rates based on your credit score. So just for comparison, if you have a credit score between 750 and 800, you're looking at a mortgage, of about, 3.62%. Versus if you're on the low end, it can jump all the way up to almost 4%, or in some cases higher. So not only is the median rate lower, but the range is much more narrow. So the worst case, if you have a really good credit score, is you're at 3.88. Whereas if you're on the, in the middle of the road or lower end at 650, you could go up to as much as 4.5%. So, and this doesn't just apply to houses, it applies to car loans, right? Any type of debt you're taking out. If you apply for a credit card, it would affect the terms of the credit card, all those types of things. So we didn't want to ignore student loan debt. So we have a slide in here focusing on student loan debt in particular. 36% of millennials have student loan debt, and it's obviously a big thing that's circulating in the news as an issue that's hampering people who are trying to get started. So the way to handle student loan debt, first and foremost, is you got to get organized. So we think you should list out all the different student loans you have. Are they private or federal? What's the total balance on each? What's the total monthly payment? And what's the interest rate? To the extent your student loan debt is private, there are some good refinance options that you should consider, especially where rates are today. A lot of times you can reduce your interest rate and your payment dramatically by refinancing the private student loan debt. On the federal side, you have to be a little bit more careful and just refinancing that without looking at the provisions regarding federal student loan debt. There's sensitivity and different options around student loan forgiveness, income-based repayment, and if you opt out, if you refinance that federal loan debt into private loan debt, you can't go back. And so because of how nuanced some of this gets, especially when you're dealing with undergrad private loans or federal loans, and then you're talking about medical school or law school, we actually, in our network, have someone we work with that we refer, and we have referred clients to who are starting out, and his name is Paul Gerard, and you can go right to his site and learn about what he does. But this is all Paul does. He used to work at Sallie Mae. He's now an independent consultant. And Paul will recommend a specific strategy. He'll analyze all your loans for a flat fee. And he's very well aware of how the CARES Act and all the legislation that's passed affects the student loans that you have. So we think that's a prudent course of action. But before you even go to him, just creating that spreadsheet and breaking down your loans into what's private and what's public or what's private and what's federal is a huge step. So this just gives you some perspective going back to 1975 through basically the beginning of this year, a 30-year mortgage, what the interest rate has been. And this is from Freddie Mac. So during the late 70s, early 80s, when we had huge inflation, you could get a 30-year mortgage for 13, 15, 17, 18%, which seems incredible today, given where rates are. But they've very gradually, since the early 80s, dropped. And the trend line obviously has been lower and lower and lower. And most recently, I believe that a 30-year mortgage rate is, a decent amount below 3%. So yeah, and this is why so many people have been, kind of frantically panic buying in the housing market. Part of it is they wanted more space because of COVID and everything we learned from going through that. But the other reason is that the debt that you can borrow is so inexpensive relative to where it was, historically. But I want to make just the point here that while it is a very good time to have a 30-year mortgage on a home at these rates, because the rates are so low, it doesn't mean you should buy a house just because rates are at rock bottom lows. Our opinion is, yes, they could go up from here, but the chances that they go from 2.5% to 5% in the next year is very unlikely. And so you just want to make sure that when you are buying a home, we'll talk a little more about this, there's a number of things you're making sure you're thinking about, not just, oh my goodness, mortgage rates are at all-time lows, I need to just buy a house now to lock it in, because that can be tempting. So when should you buy your first home? It really is an individual decision. It depends on a number of factors. One of the factors is if you're just starting out or your first or second job, you want to make sure you have some visibility or clarity into, are you in a job where you think you can grow and be there for several years, right? Is there some sort of a career path? Renting has benefits. You have a lot more flexibility. If you don't know where you're going to be living in the next 6 months or year, renting is certainly going to be a good option. And then also, the longer you wait, the more of a nest egg you can build up, more savings you can accumulate, more down payment you can put on a house, and the better terms you can get. So, there's a number of factors that go into, purchasing that first home. And I'd say a decent amount depends on as much on your life situation as it does on the pure financials. And so you got to make sure you're looking at your life situation in addition to, okay, yes, I have the money to buy a house and, I'm ready to move forward. The other thing I would add, a lot of people talk about, well, if I buy this house, in 10 years, it'll be worth this. And so it's actually an investment. Just as a general rule of thumb, we don't think it's wise to think about where you're living as an investment. And the reason is because when you buy a house, it's possible that it could appreciate more than inflation during the time period you own it. But a house is somewhere to live. It's not an asset that produces any sort of cash flow. And so relying on your primary residence to go up in value as part of your long-term investment plan is not advisable. The way we run financial plans is we assume that your house will go up by whatever we're assuming inflation is going to be, 2.5%, 3%, but we never assume more than that. If you get more than that, great, but you should not count on it. You should not count on it. This just goes back to looks at a chart from the National Association of Realtors on the median age of all buyers of homes in 2019. It's 47. For first-time home buyers, the age is 33, so probably a little bit higher than a lot of people think. Repeat buyers, age 55. But you can see over time, gradually, things have been trending up, the median age, right? And this is something we know. A lot of millennials aren't buying houses, they're renting. They're renting with friends or colleagues or people like that, and they're just not buying homes. So that's why the age, you can see here over time, the age of median age of first-time buyers, home buyers has gradually trended up over time. Okay, not as exciting a topic, but still very important is the understanding the basics of insurance, right? Insurance is a necessary evil. No one wants to bet against themselves. However, what you have to think about with insurance is there is always a possibility, even if it's small, 1%, 2%, 5%, right? That something happens that's fairly drastic and without insurance would have a significant effect on you financially. It could be also not financially, but in this case, we're talking financially. And so what I'm going to talk about here are some of the basics of different types of insurance that you should understand and think about when you're starting out in your career. Obviously, if you're starting out and just graduated from school, one of the things you should look for, unless you're very entrepreneurial, is making sure that whoever offers you the job, that you have basic benefits, health insurance, they give you a 401k, are they offering you a match? What are the benefits? And more companies, especially the big companies, are enhancing kind of the non-financial benefits that they offer, whether it's work from home flexibility or they have gym equipment at the office, whatever it is, that's becoming more and more commonplace and is kind of part of how you should think about your overall compensation package. First type of insurance we're going to talk about here is health insurance. Health insurance, think about health insurance this way. If you get sick and you go to the doctor, or if you're ill and you have to go to the hospital, who pays the medical providers? The nurses, the doctors, the hospital, who pays them? Your health insurance provider pays them, right? You pay the health insurance provider a premium, a monthly premium, okay? And in exchange for that premium, if something happens, you have a medical bill, there's an arrangement, okay? And that arrangement deals with a deductible, a co-payment, and what the insurance company is going to pick up. So every month you pay a premium, okay? That premium is going to be driven by the type of coverage that you have. Generally speaking, the higher the premium that you pay, the lower your out-of-pocket costs are going to be when you go see a medical provider. But there's some key terms that you need to understand when it comes to health insurance. The first is your deductible. Okay, so even though you're paying a premium every month, when you actually go, some visits, like if you're going to see your primary care physician and it's a once-a-year thing, that may be covered as part of the basic coverage and you don't have to pay a deductible. But let's say you're going to see a specialist or you need a surgery that's going to have to be done. Now, most likely you're going to have to pay some sort of a deductible. And that deductible is largely driven by the type of plan you have and the premium you're paying. The higher the premium you're paying, generally speaking, the lower that deductible. The lower the monthly premium you're paying, the higher the deductible. Kind of makes sense, right? The insurance company is saying, if you're going to pay us more up front, then we'll share in more of the costs up front. If you're going to pay us less up front, you're taking on more of the risk. If something happens, you'll pay a higher deductible. That deductible is capped. So each year it resets, and it depends on the type of plan, but it's generally capped at $1,500 or $3,500, something like that. And it could be for an individual or a family. Beyond that deductible, if you have met that deductible, then what happens is the insurance company essentially kicks in for some percentage. Could be 90%, 80%, sometimes 100%, but they essentially then start to kick in and pay the majority of those costs. And then that will occur up to when you reach what's called your out-of-pocket maximum. The out-of-pocket maximum is essentially the most that you're going to pay out of pocket in any given year. And you should look for what the out-of-pocket maximum is in your plan. That's kind of your full exposure, your full risk in any given year. Generally, that's going to be 7,000, 10,000. It would occur only in the event of a major medical cost, hospitalization, major surgery, things of that nature. I will tell you, my brother-in-law's having some back issues, and it's a good example. He's his first job out of school, and he has health insurance, and he pays it every month. But because of the MRIs and the CAT scans and things of that nature, the expenses that he's incurred as a result, like the amount he has to pay at the deductible, are quite sizable. So it's just a good example, going back to that emergency reserve. If something happened that's unexpected, even if you're young, you could be looking at a $500,000, $1,500 bill in terms of your deductible that you still have to come up with, even if you have health insurance. The copayment is the amount one has to pay on top of the deductible. Sometimes if you go to a specialist, rather than paying the deductible, you'll have a copayment of $40 or something, and that's what you pay. So those are the key terms. You can look them up separately just to kind of familiarize yourself with them. And the one other thing I would mention for young people starting out is, if you are in good health and you basically go to the doctor once a year for your checkup, but no issues, you may want to consider looking at what's called a health savings account, or an HSA. And what that allows you to do is pay a lower premium and then take basically an amount of your choosing, and you can do up to 3,000 or 4,000 per year for an individual, I believe. I don't have the exact numbers, and put it into a pre-tax HSA account. And that money goes in pre-tax. You can actually invest that money. So you could buy a diversified mutual fund, for example. That money can grow. And as long as it comes out for medical expenses, it comes out tax-free. So it's the only account where the money an HSA that goes in pre-tax, can grow tax deferred, and comes out tax-free. So it's a triple tax, specialized accounts, triple tax-free account. It's the only type of account that's out there that does that. Of course, because of that, you can't put that much into it, but it is something that you're starting out, and generally speaking, in good health, you would want to consider. Okay, next up, disability insurance. Easiest way to think about disability insurance is, if you get sick, we just talked about health insurance. You get sick and go to the hospital, who pays the doctors? Your health insurance company, right? If you get sick and you can't work, who pays you? Not health insurance. Work's not going to pay you, right? If you're unable to work. Disability insurance is what would pay that. And most people, when they're starting out, do not think about disability, right? Because they're in their prime, they're young, they're healthy, and so the last thing they're thinking about is being unable to work because of an illness. But the reality is that from when you start work to age 65, about 1 in 4 people will have a long-term disability. It doesn't necessarily mean that they're out of work permanently, but it means they're out of work for more than 3 months. And this shows you actually the things that cause it. And it's not what most people think, which is a physical injury or getting into a car accident. As tragic as those are, most of the causes of these types of disorders are things like an illness, a musculoskeletal disorder, or something like cancer. Think of it this way: if you're a dentist or an architect or any type of surgeon, and you developed any sort of nervous system issues, whether it's MS or Parkinson's or something where you can't keep your hand stable, think of it this way: when you're starting out, your greatest asset is you. It's you, right? Because your work is what's going to produce the money that's going to allow you to save into your 401k and save into your savings account and invest. If you are not able to work, guess what? The whole thing falls apart. So in order to protect that, you want to look for, you need to obtain disability insurance. A lot of employers offer it, and we would encourage you to get the short-term and the long-term disability option. And if you are in a specialized field of work, you also probably want to look at private individual insurance to make sure that if you left that employer and went somewhere else, and that new employer didn't offer the disability insurance as a benefit, that you don't have a lapse in coverage. Obtaining disability insurance while you're young and healthy is a lot more important. It is very important, and it's a lot less costly than if you wait until you're in your mid-30s or 40s to get it. Homeowners and renters insurance, any sort of event that would put your house or your belongings in jeopardy, homeowners insurance helps to protect that. If you're just renting and you want to protect your belongings and things like that, you would go with something like renters insurance. And here's all the different things that might happen. But anyone who's lived in a home knows things break, things happen, and a lot of times you're going to have to make a claim. I know I've made a claim for my auto and homeowners over the last 15 years. And by the way, if you're getting a loan on your mortgage, they'll require you to have homeowners insurance. So it's not a choice. Okay, we're going to finish up here with some behavioral finance topics. And this all relates to decision-making with your money and when it comes to investing. And the reason this is so difficult is because when people are making decisions around money and there's uncertainty involved, there's cognitive biases at play that we all experience. And if you're not aware of what those biases are, or it tends to be the pattern of behavior under certain parameters, you're more likely to fall prey to them. Okay, so this is not a cure-all, it's just you want to be aware of this, because behavioral finance and the research that's been done around decision-making with, around uncertainty, and particularly with money, there's a lot of biases that are at play. So let's first look at kind of this chart on the right that I think does a really good job of showing how market cycles work. And it's using emojis to do so. So you can see as the market goes up, what happens is people get more excited, more optimistic, and kind of at the peak here, you have almost like a euphoria. And the euphoria is thinking of, oh my God, this thing is going to go up forever and I'm going to be rich, and it feels great. And that generally, not always, but as a general rule of thumb, the more kind of panic buying you're seeing, the more greed, the more euphoria, it generally means the market is frothy, right? It's been overbought. And so that a lot of times represents the point where the market actually starts to turn. And then you kind of have complacency. Oh, it's flat. Now I haven't made any money recently, but I've still made a ton. And then it starts to go down. You get anxious, keeps going down. There's denial, keeps going down, right? And normally when what this is happening, think of March of 2020, something in the world is very broken to lead to this type of, to lead to this progression of negativity and fear and things declining assets. So what happens is kind of towards the bottom, there starts to be panic. People start to panic and say, oh my God, just like here, it's going to go up forever. Here, it's going to go down forever. And then they sell. And then things start to kind of bottom out and like, oh my God, I shouldn't have sold that. Things start rising again. And then the cycle repeats. This is obviously oversimplified, but it does explain a lot of market activity at different points in the cycle. Warren Buffett has a very famous quote saying, be greedy when others are fearful and be fearful when others are greedy. And he's talking directly about this chart, right? Where is the market, or where are investments when everyone's depressed and things are very, very negative? At the bottom, right? Things are the cheapest here. Whereas here, when people are euphoric and excited and want to put everything into investments, where's the market generally there? At a high, right? So for people attending this webinar and for young people starting out, what we would say is the most important thing is to invest on a consistent and regular basis and have a long-term time horizon. The news, your friends, things you read online, they're all going to be talking about various points in this cycle, whether it's excitement or denial. But the key thing that's missing in terms of how it should relate to you is they're reporting on something that is happening in a day in time, a week in time, a month in time. What you need to remember is that your time horizon is 20, 30, 40, 50 years. It doesn't matter. Even if you invested in October 2007, right before the crash, or February 2020, if you look today, right, your money would still be worth materially more than it was then. So you have to take that long-term time horizon and really, to a large extent, ignore the financial news that is, it's great to read financial news that's fact-based, but so many of the headlines that I read, Dow has worst day since last October. That happened yesterday. Well, The Dow did. It dropped 700 points. But as a percentage, people who think about how the market's moving based on number of points, I don't think are accurately understanding what's happening, because it's always based on what the value of that asset is. So if the Dow's at 34,000, it goes down 300 points, right? That's only 1%. 20 years ago, if the Dow went down 300 points, that was a lot more meaningful because the Dow wasn't at 34,000. So don't pay attention. A lot of this stuff is noise that you should filter out. Here are examples of different biases: sunk cost fallacy, overconfidence bias, hindsight bias, confirmation bias. There's a saying, there's a guy, Adam Robertson, who was a chess master at a young age. He's friends with Warren Buffett. He's an advisor and consultant to a lot of hedge funds now. And one thing he said about the internet that I thought was so interesting is he said, when you go on the internet, it's one giant confirmation bias. That's probably a little bit of an exaggeration, but not terribly, right? Because if we are searching on something on the internet, generally you're asking a question based on what your narrative is of the world, or how you think the world is going to play out. And so what are you going to get fed back? Things that support, right, your view of the world. So some of these things are so latent in how we process information that we're not even aware of them. Hindsight bias is one of the trickiest ones, because once something happens, so if I'm making a prediction about the future, it's inherently uncertain. But once that event happens, it happened. It literally, so then you look back and say, well, it happened, so I obviously was wrong. Well, not necessarily, because reality could have played out a different way, right? A good example, an extreme example of this is, let's say you're playing, if there's a game of Russian roulette, okay? There's a 1 in 6 chance that you're not going to make it past when that trigger is pulled, right? That's Russian roulette. So if the trigger gets pulled and it's empty, hindsight bias, you can say, see, I knew it all along. My chances, there was a 5 in 6 chance that I was going to live. I was willing to take that risk. There's a huge payoff. But you can't look at it that way, because there was a 1 in 6 chance that your life would have ended. So I apologize for the extreme example, but I just think it's so important that as soon as something happens and it becomes fact, it's so easy to say, I knew that all along. That's hindsight bias. So I won't go through all of them, but that's the type of example. And here's kind of example of hindsight bias or overconfidence bias playing out, right? Hindsight bias, your memory can easily be distorted. Oh, I said that would happen, or oh, that had to happen, or I knew that would happen. Almost always. And the way to know how accurate you really are, and I've started to do this a little bit, is you keep a decision journal and you say, here's what I think is going to happen. Here's why. Here are the consequences if it plays out. Here are the consequences if it doesn't. And what's amazing is how difficult it is to predict. And if you're honest, you'll see that you're wrong as much as you're right about what's going to happen. So just be really careful of the biases at play. And this goes for experienced investors and adults, as well as people just starting out. It's not really unique to just people starting out. So I'd love to take questions if there are any. But if you have questions and you want to ask us individually, you can email us at info@4jwealth.com. We have more resources regarding any of the topics covered today. This is also being recorded, so you can watch this later on. We think this information is so important. So, the last thing I would say here is, in summary, as a wrap up, if you just wanted to have the 30-second Cliff Note version of how to be successful, and so much of you, if you can do this stuff, these 4 things in your 20s, you're really setting yourself up for life. So 1, spend less than you make. Figure it out early, whatever you have to do to get your spending to be less than you make, right? Another way to say it is live within your means. It can take some discipline and some effort up front, but it is critical to do that. Number 2, get 3 months worth of expenses in the bank. Save 3 months of expenses. Anything above and beyond that should be invested for your long-term future, which means not in cash. It should be invested in something that can grow in excess of inflation. I think a great example of that is a diversified index mutual fund, or a collection of funds with a long-term time horizon. And then number 4, be patient and be disciplined. Truly, if you can follow these 4 things, you have a really good chance, I think, at being successful over the long term. These are the things you can control, right? There's a lot that's outside your control. Here are the things you can control. And if you do this, you're increasing the odds of your success dramatically. And the sooner you can do it, the bigger the effect it will have later on. Thank you so much for attending. We have about 5 minutes left. So if there are questions, please type them in to the Q&A, and we'd be happy to answer them.
Josh, we've got a question on credit scores.
Okay.
And the question is, can those affect the cost of insurance or getting a job? Like, in other words, how much insurance would cost or your ability to get a job? Could a low credit score have an effect on that?
It's a very good question. At least in the life insurance and the disability insurance front, my understanding is they do not check your credit score per se, but they will look at, for disability insurance, they'll look at your income over the last 2 years. And they will ask some general questions about your financial circumstances, the purpose of purchasing it. But I am not aware on those types of insurance that your credit is actually pulled. I don't know if you have any familiarity with on the homeowner insurance front, whether the credit check is I've never seen that come up. I guess it doesn't mean it could be getting checked. We might have to look into that, but I have never seen it come up personally or professionally with that. They looked at that.
Yeah, I believe, at least for like your car insurance and home insurance, it shows a pattern of being responsible, right? If you have a good credit score.
Yeah.
Which can then affect, I think, the overall cost. And certainly with getting a job, right? That's one of the 4 or 5 things a potential employer is going to do is pull
right.
up and take a look at your credit score.
Yeah, that's a great point. With the job front, definitely they can pull the credit report. And depending on the industry you're in, oftentimes they're required to pull a credit report. That's a really good question. So again, it comes back to, though, make sure, right, you do the things we talked about with to keep your credit good, to increase your score. Keep in mind everything we talked about. Any other questions?
Let's see, there's a question on, and I think this goes back to something you said earlier about making Roth contributions, especially early on. Is there a time when you would want to switch from making a Roth IRA or Roth 401k contribution over to a traditional IRA, traditional 401k contribution?
That's another really good question. I would probably be looking at where you are from a tax bracket standpoint and where you are in your career. I mean, if you're starting to hit your stride in your career and your tax bracket has gone up significantly to where it's, on the, maybe not the top bracket, but the top 3 brackets. Okay. I think then you really have to look closely at switching to the traditional 401k because giving up that tax break today at 30 cents on the dollar, for example, not including the state savings is pretty significant. So I would say as your income starts to increase and your tax bracket starts to go up, it should be reevaluated. But I don't know. I don't think I could say for sure. Like if you're in the top 2 income tax brackets, I think it's a no-brainer to do the traditional route. To switch to traditional 401k to get the tax break today. But it does depend on your circumstances and your family situation, all those things.
Right. Good answer.
All right, is that it?
That looks like it.
All right, fantastic. Thank you everyone for attending. We'll get this up recorded on YouTube the next day or 2. And if you have any questions for us directly, info@4jwealth.com. Feel free to share this with people who would benefit. Thanks so much. Bye-bye.